Daniel and Robert each have $60,000. Daniel uses his money to buy a rental property. Robert puts his into a broad stock market index fund. 20 years later, both men can point to a respectable amount of wealth, but one of them has spent years dealing with repairs, tenants, debt, and paperwork. The other has watched his account fall by tens of thousands of dollars during market crashes and had to resist the urge to sell. So who made the better decision? That sounds like a simple question. It becomes much harder once we include every cost, every hour, and every risk. Let's give them the same starting point. Both are 38 years old. They earn similar salaries, live in the same area, and have $60,000 available to invest. They want to build wealth over the next 20 years, and neither plans to touch the money before then. Daniel buys a $300,000 rental house using his $60,000 as a 20% down payment. Robert invests the full $60,000 in a low-cost total market index fund. From the beginning, Daniel's decision looks more impressive. He now controls a $300,000 property with only $60,000 of his own money. He has a tenant sending him rent each month. He can drive past the house, walk through it, renovate it, and eventually sell it. Robert receives an email confirming that his investment order was completed. That difference matters more than people admit. Real estate feels productive. You can see the asset. You can make decisions. You can improve it. There is always something happening. Index investing often feels like standing still. You put the money in, continue with your life, and hope that thousands of companies become more valuable over the next few decades. There are no keys in your pocket and no monthly rent payment arriving in your bank account. But an investment should be judged by what it gives you after costs, taxes, time, and risk. The most visible choice is not automatically the most profitable one. Daniel and Robert are both 38. Each has $60,000 available to invest, and both plan to leave the money working for 20 years. Daniel buys a hypothetical $300,000 rental property. He puts down 20%, which uses the full $60,000, and finances the remaining $240,000 with a 30-year mortgage at 7% for this example. His principal and interest payment is about $1,600 a month. The house rents for $2,550. That gives Daniel a visible gap of about $950 between the rent and mortgage payment. It looks excellent until the property's other expenses begin taking their share. Property taxes cost roughly $300 a month. Insurance takes another $125. We'll reserve 5% of the rent for vacancy and about 1.5% of the property's value each year for maintenance and major replacements. After those costs, Daniel's first-year cash flow is close to zero. That may sound disappointing, but the cash flow is only one part of his return. His tenant is also paying down the loan, and Daniel owns the appreciation on the full $300,000 property. Robert's calculation is simpler. His $60,000 goes into a low-cost total market index fund. For this illustration, we'll use an 8% average annual return. That return will never arrive in a smooth line. Some years could be excellent. Others could be deeply negative. 8% is simply the long-term assumption we'll use for the comparison. Robert reinvests the dividends and leaves the account alone. No extra monthly contributions yet. Both men have invested exactly $60,000. After 5 years, Robert's index fund would be worth approximately $88,000 at an 8% average return. Daniel's house, assuming 3% annual appreciation, would be worth around $348,000. His remaining mortgage balance would be roughly $226,000, giving him about $122,000 in gross equity. Daniel appears to be ahead by more than $30,000. Leverage created most of that difference. Robert's $60,000 controlled $60,000 of investments. Daniel's $60,000 controlled a $300,000 property. A 3% increase in the house's value produced a $9,000 gain during the first year, even though only $60,000 belonged to him. The tenant also reduced the mortgage balance with every payment. But Daniel cannot place the full $122,000 in his pocket. Selling the property would involve commissions, legal expenses, possible repairs, and taxes depending on his circumstances. A sale could easily remove tens of thousands from the number he sees on paper. Robert could sell his fund much more easily, although he might also owe taxes on the gain. Daniel still leads at this stage, but his money is harder to reach and far more concentrated. One house, one neighborhood, one local rental market. Robert owns small pieces of thousands of businesses. At year 10, Robert's original $60,000 has grown to approximately $130,000. Daniel's property is now worth around $403,000 under the same 3% appreciation assumption. His mortgage balance has fallen to about $206,000. That gives him roughly $197,000 in gross equity. The rental should also be producing better cash flow by now. Rent has risen gradually while the principal and interest payment stayed fixed. Taxes, insurance, and maintenance also increased, but Daniel may now keep several $1,000s a year after expenses. Across the first 10 years, his cumulative cash flow might total around $20,000 under these assumptions. Once we include that cash flow, Daniel has built approximately $217,000 before selling costs and taxes. Robert has around $130,000. Real estate is winning clearly. But this result depends heavily on one assumption. The house appreciated by 3% every year on average. Reduce that rate to 2%, and the property would be worth roughly $366,000 at year 10, rather than $403,000. That single percentage point removes about $37,000 from Daniel's apparent lead. The purchase price matters even more. If Daniel overpaid by $25,000 at the beginning, suffered a major repair early, or bought in an area where rents barely moved, the advantage could narrow quickly. Real estate investors often say the profit is made when you buy. This is what they mean. Leverage magnifies a good purchase, but it also magnifies a weak one. Robert does not have that same purchase price problem. He invests across the market at whatever prices exist that day. His major risk comes later, when the market falls and he has to decide whether to remain invested. Now we reach the first fair result. Both men invested $60,000. Neither received additional money. At an 8% average return, Robert's index fund grows to approximately $280,000 after 20 years. Daniel's house, appreciating at 3% annually, is worth around $542,000. He still owes about $138,000 on the mortgage, leaving roughly $404,000 in gross equity. Assume selling costs consume about $32,000. Daniel would keep approximately $372,000 from the property before considering taxes. Over those 20 years, rising rent may also have produced close to $100,000 in cumulative cash flow after our allowances for taxes, insurance, vacancy, maintenance, and major replacements. That puts Daniel near $470,000. Robert has around $280,000. Under these assumptions, the rental wins by almost $190,000. That is the power of buying a larger asset with borrowed money and having someone else help repay the debt. But Daniel's $470,000 still leaves out two costs. The first is property management. The second is his time. Our calculation assumes Daniel manages the house himself. If he hires a professional manager charging around 8% of collected rent, management could consume more than $60,000 over the full 20 years. His result falls from roughly $470,000 to about $410,000. Real estate still leads, but the gap has become much smaller. If Daniel manages the property himself, the money remains in the investment, but the work moves onto his calendar. Suppose the property requires an average of 5 hours a month. Some months require almost nothing. Others involve tenant screening, inspections, bookkeeping, contractor visits, late payments, insurance claims, or an empty property that needs to be prepared quickly. 5 hours a month becomes 1,200 hours over 20 years. Value that time at $40 an hour, and Daniel contributed another $48,000 through unpaid labor. Now his economic result is closer to $360,000 after management is replaced by the value of his time. That still beats Robert's $280,000, but the original $190,000 advantage has fallen to around $80,000. One bad event could narrow it further. A long vacancy, difficult eviction, foundation problem, major water damage, or weak local housing market can remove years of profit. The average calculation does not show how uneven the experience may be. Now let's give Robert the advantage he receives in many online comparisons. He invests another $400 every month. After 20 years at an 8% average return, his portfolio grows to approximately $530,000. That beats Daniel's estimated $470,000. It also requires Robert to contribute another $96,000. The result tells us that regular saving and compounding can overcome the advantage of property leverage. It does not prove that the index fund produced more from the same amount of money. To make the comparison equal again, Daniel must also receive $400 a month. He could use it to pay down the mortgage faster, build reserves, or invest in the same index fund Robert owns. If Daniel invested that $400 in the market while continuing to own a self-supporting rental, he could finish with the property wealth plus a substantial stock portfolio. If he applied it to the mortgage, the loan could be paid off years earlier, allowing him to keep much more rental income during the final part of the comparison. Under equal contributions, Daniel may lead again. This exposes the larger lesson. The asset matters, but the amount invested over time can matter even more. A person investing $400 every month into an average asset may build more wealth than someone who buys an excellent asset once and never adds another dollar. Stocks become more attractive when Daniel's property assumptions weaken. Suppose the house appreciates by only 2% rather than 3%. After 20 years, it would be worth about $446,000 instead of $542,000. That change removes nearly $100,000 from the property's value. Add professional management, selling costs, and a few expensive repairs, and Robert's passive portfolio can come out ahead even without spectacular market returns. Stocks also give Robert flexibility. He can sell a small portion of his account. Daniel cannot sell 10% of the kitchen. Robert can move to another city without affecting the investment. Daniel's property remains tied to one local economy. Robert can increase his investment by $50 or $500 whenever he chooses. Expanding a property portfolio usually requires another down payment, another loan, and another large commitment. The hardest part is surviving market declines. A portfolio worth $400,000 can temporarily fall to $280,000 during a severe downturn. Robert must continue following the plan while the loss is visible every time he checks the account. Many investors discover too late that their real risk tolerance is lower than they believed. The index fund requires almost no physical work, but it demands emotional control. Real estate becomes more powerful when Daniel buys below market value, improves the property intelligently, or finds an area with a strong relationship between rent and purchase price. A better purchase could give him positive cash flow immediately, rather than forcing him to wait for rents to rise. He also has control over the outcome. Daniel can improve the property, reduce unnecessary costs, screen tenants carefully, refinance when appropriate, or add value through renovations. Robert cannot directly improve the thousands of businesses inside his index fund. Property can also be especially effective for someone willing to treat it as an operating business. An experienced investor with reliable contractors, strong cash reserves, and disciplined buying standards may produce results far above our example. A reluctant landlord who buys because property seems passive may produce far less. With our original assumptions, real estate produces more wealth from the same initial $60,000. The advantage comes from leverage, mortgage repayment, and appreciation on a much larger asset. Once we charge Daniel for management or value the hours he spends working, the difference narrows. When Robert adds $400 a month, his stock portfolio can overtake the rental. But that result comes partly from saving an additional $96,000. Change the property appreciation rate by 1 percentage point, and the outcome can change again. This is why the winner cannot be decided by saying that houses appreciate or stocks compound. Both statements are true. Neither completes the calculation. Choose real estate when you understand the local numbers, have enough cash for unexpected costs, can tolerate debt, and are willing to manage either the property or the manager. Choose broad index funds when you value diversification, liquidity, and simplicity, and you can remain invested through serious market declines. Some investors will eventually use both. The important part is keeping the comparison honest. Use the same starting money. Track every additional contribution. Include selling costs, maintenance, vacancies, debt, and time. Then test what happens when your return assumptions are slightly wrong. A good investment should still work when the future is less cooperative than the spreadsheet. Gray finances. Money decisions made clear.